Dark cloud cover is the same general price action of a bearish star, except it takes place over the course of 2 candles. In theory, it's a bit less bearish than a bearish star, since the same price action takes longer to complete. This is because the first candle, which is green, continues an existing uptrend, up to the point of the open for the second candle, which is always red, and will close to the halfway point or lower of the first green candle. But it does not go below the low of the green candle. It can get close to the low or the open of the first green candle, but this is rare and less ideal. A strict dark cloud cover formation will normally close towards the halfway point of the high-low range of the first green candle, resulting in a green bearish star when the 2 candles are combined. Thus, the open of the first candle to the open of the second candle is similar to the formation of the upper wick when a single bearish star forms. Then, the lower portion of the dark cloud cover from the close of the second candle to the absolute low of the whole formation at the low of the first green candle resembles the bearish intent of a hanging man that is yet to be fully realized. Dark cloud cover is quite a suitable name. There is bearish intent in the market to take prices lower, but not to the same strong degree as a single bearish star. At the same time, it is more bearish than a hanging man candle, in theory, because the market ends lower, with stronger intent for lower prices. It is similar to looking at the weather when dark clouds give a high chance of rain. The second red candle is similar to those dark clouds in that it does give a much higher chance of falling prices. The chances of a downtrend developing are increased even more when once again this is found during an existing uptrend near an area of existing resistance, and the next candle trades below and closes below the low of the dark cloud cover, which will be the low of the first green candle. A piercing pattern is to dark cloud cover what a bull hammer is to a bearish star. It is a 2-candle pattern that indicates the possibility of an upward reversal. The first red candle continues an existing downtrend. Then the second candle, which is always green, opens even lower but moves higher, eventually to close at or near the halfway point of the first red candle's high-low range. Indeed, it is quite close to the price action of a single red bull hammer. That means all the features discussed about the dark cloud cover apply to the piercing pattern, except in the reverse. A bearish kicking pattern first begins with a green candle, followed by a gap down, to open a second red candle. This results in a higher potential for a downward reversal of an existing uptrend, since the resulting combination of the 2 candles is similar to the general price action of a bearish star. That will always be red, since the second candle will always be red and close lower, below the low of the open of the first green candle. As would be expected, there is a bullish counterpart, not surprisingly called the bullish kicking pattern. Therefore, the exact same statements about the bearish kicking pattern apply, except in the reverse. Kicking patterns often form during volatile periods in the market because gaps are a very distinct feature when the market has rapid fluctuations during volatile times. Kicking patterns can also form in an overlapping variation. Everything is the same except there is no gap between the candles, and instead the real bodies overlap. In theory, this shows a lower degree of intent to strongly reverse the market. However, at the same time, there are no gaps, which means the market is likely more stable and less volatile.